Welcome back to the deep dive. So you've handed us a stack of reports on FedEx Corporation, and we are going deep into their fiscal second quarter 2026 earnings.
That's right. And these results dropped at, well, the most intense time of the year for them.
Exactly. We're not just looking at numbers. We're setting the stage here. This is peak season. We're talking global supply chains under, massive strain, millions of packages in motion. The mission for you today is to understand how a giant like this navigated that chaos while also running the biggest internal transformation in its history.
And if you want the high-level answer right up front, they didn't just navigate it. They found some serious operational power. FedEx reported, frankly, an unexpectedly strong Q2.
Strong despite all the headwinds we're hearing about.
Yes, despite significant headwinds, higher labor costs, global trade volatility, you name it, they still managed to pull off high revenue and earnings growth year over year.
Okay, let's unpack this. We're looking at a huge company pulling in $23.5 billion in revenue for the quarter. Where should we even start to illustrate that execution strength?
We have to start with the consolidated scorecard and specifically the year-over-year comparison, because that's where the strategic work really starts to show up.
Got it.
Consolidated revenue hit $23.5 billion. That's a solid 7% increase year over year. But honestly, the story isn't just revenue, it's profitability.
Okay, so give us the adjusted income metrics.
Adjusted operating income climbed strongly to $1.6 billion. That's a 17% growth year over year.
17%, wow.
And the adjusted earnings per share, the EPS, came in at $4.82, which is an exceptional 19% growth.
Yeah.
They also achieved margin expansion of 60 basis points.
Wait, let's pause on those percentages. 17 and 19% growth. Analysts call that high teens growth. That's kind of the gold standard right now.
Yeah.
But is this sustainable? Or is this just, aggressive cost cutting that might hollow out the business later?
It's a crucial question. If it were just cost cutting, yeah, margins would improve, but you'd expect service quality to suffer. But what's so remarkable here is that margin expansion, 60 basis points. For you, the listener, that means they improved their operating margin by nearly 0.7% on a $23.5 billion base spend. That's a massive amount of improved efficiency per dollar.
So it wasn't just cuts.
No, the core driver was commercial execution, specifically maintaining pricing power, which in logistics we call yield, and that was coupled with real volume strength across their U.S. domestic package services.
So yield and volume, that's the perfect operational cocktail. But if we cut through all the noise, what was the single largest engine powering this success?
Oh, that absolutely belongs to the Federal Express segment, the FEC segment. It was the powerhouse this quarter.
Okay.
It delivered an 8% increase in revenue, but the adjusted operating income grew by a whopping 24%.
A 24% jump. That's profit growth outpacing revenue growth.
Yes.
That's what people call the holy grail of logistics management, right?
Yeah.
It shows efficiency is rising faster than the workload.
Precisely. And the detail shows strong, healthy demand, particularly right here in the U.S. market.
So what did that look like?
If we break down their U.S. domestic package services, revenue growth was up double digits across the board. Priority was up 11%, deferred was up 16%, and ground was up 11%. It just proves that the strategy to integrate their domestic networks is bearing real fruit.
And here's where it gets really interesting, though. They achieved that 24% income growth while fighting some serious internal and external battles.
Yeah, absolutely did.
They had higher wage rates, increased variable incentive compensation, and they grounded a significant part of their air fleet, the MD-11 aircraft.
Right, the MD-11 grounding is a great example of managing a strategic headwind. Grounding a large portion of a heavy lift fleet is a huge operational decision.
It's not just like parking a car.
No, not at all. It means taking aircraft capacity offline, which costs money, and then forcing packages onto other, sometimes less efficient routes. And you're still paying for the plane and its crew.
So were they essentially paying for plane parking, or was this a strategic long-term move, like for fuel efficiency or something?
It was a strategic long-term fleet optimization move, but it has a very real short-term financial drag. So to absorb those costs, the MD-11 grounding, the higher labor costs, and still deliver a 24% jump in operating income, it just means the structural changes they're making are really working.
Okay, let's pivot to those structural changes then, because that's the fuel for the future. What initiatives are underpinning this resilience? We hear a lot about the big one, Network 2.0.
Network 2.0 is the most significant. It's essentially rewiring their entire domestic operating model, combining the ground and express networks into one cohesive system.
And are they making progress?
They're deep into it. We have a tangible marker. Approximately 24% of their eligible average daily volume is now flowing through 355 of these new Network 2.0 optimized facilities.
Okay, 24% through 355 facilities. What does that actually mean for me as a customer or just an observer?
It means they're getting closer to true integrated operations. Every single package going through an optimized facility means fewer touches, less sorting, reduced travel distance.
So faster service, lower costs.
Faster service, lower fuel use, and lower labor costs per package. It's tangible progress on a massive, really complicated infrastructure project.
And it sounds like they're being just as dynamic globally with managing their air fleet.
Absolutely. They are ruthlessly optimizing their fleet deployment to cut costs where volumes are slow. They reduced their purple tail, that's their own fleet trans-Pacific capacity, by about 25% year over year.
And what about the charters?
They trimmed their white tail, that's the third-party chartered capacity, the really expensive kind, even more aggressively, by around 35%.
So parking their own jets and cutting back on expensive charters. Is the message here that FedEx thinks that huge global air freight boom we saw is over?
That's precisely the implication. They're recognizing the softness in the big trans-Pacific lanes and right-sizing the fleet to match reality. But they aren't just pulling back everywhere.
Okay.
Now, they're strategically shifting capacity toward the Asia to Europe lane, which shows they're adapting to where global trade is actually flowing right now. It's efficiency and geopolitical awareness.
That sounds like a masterclass in operational efficiency. But the other side of this transformation coin is digital. What's the scale of AI adoption at FedEx?
What's fascinating here is the sheer scale of the investment in their people. This isn't just about a new piece of software. They are scaling AI adoption with a tiered, customized curriculum across the entire company.
How many people are we talking about?
Over 500,000 employees.
500,000 people? That's massive. That tells you they're treating AI as a fundamental skill for the whole workforce, not just some IT department tool.
Exactly. They view AI as augmented intelligence for their existing staff. They're customizing the curriculum for each person's role, whether you're a pilot, a packet handler, a dispatcher. No competitor has announced anything at this scale.
And it seems like technology is moving beyond just being an internal tool. It's now creating new revenue opportunities for them, right?
It is. They're actively selling their unique logistics intelligence insights. That new strategic collaboration with ServiceNow is a perfect example. It shows how valuable all that internal data they collect really is to other businesses.
Now, we have to turn to the segment that was struggling. FedEx Freight, or FXF. We need to acknowledge the pressure points here, especially with the upcoming spinoff.
Right. FedEx Freight's results were definitely pressured, which, to be fair, is consistent with weak trends across the whole LTL, or less-than-truckload, industry.
So what did the numbers look like for them?
Q2 FXF revenue declined 2% year over year, and adjusted operating income fell by a pretty significant 22%. The main cause was just lower average daily shipments.
Okay, a drop in volume is tough, but there's a crucial counter detail here that really speaks to their strategy. Despite that volume decline, FXF's revenue per shipment, their yield was actually 2% higher.
That is the key signal of strategic discipline. It shows their team is prioritizing revenue quality, charging more for better service over just chasing weak volume. In a soft market where competitors are slashing prices to fill trucks, FXF is holding the line on price.
And looking across the whole organization, that focus on yield is paying off with big commercial wins, particularly in B2B.
Absolutely. The focus is on premium markets. Nearly half of their Q2 revenue growth came from B2B customers in high-value sectors like healthcare, automotive, and aerospace. They're also establishing a new data center sales vertical to target that explosive growth in cloud infrastructure.
So it's a focused hunt for premium revenue.
It's not accidental, that's for sure. And even for small and medium businesses, their digital strategies are improving efficiency.
How so?
They're using digital tools to give customers better visibility. Where is my package exactly? And that simple thing leads to reduced customer service calls and fewer data outages. Better data just means less friction and lower costs for everyone.
Okay, so looking forward, it sounds like the company is feeling confident enough to raise its full-year forecasts. What's the revised view?
The revised consolidated revenue outlook is now for 5% to 6% growth year over year. And importantly, the adjusted EPS forecast is now solidly in the range of $17.80 to $19 per share.
And what's underpinning that confidence?
It assumes that the U.S. domestic yield and volume strength we saw in Q2 will basically be sustained through the end of the fiscal year.
And how do they see the two core segments stacking up for the rest of the year?
For the powerhouse, Federal Express, they're now expecting about 7% revenue growth.
Hmm?
But for freight, the outlook is flat to slightly down year over year. They're anticipating a low single-digit decline in shipments, but they think that'll be offset by continued yield growth.
So they're confident in their pricing power going forward.
They are, and they're backing it up with action. They expect a strong capture of the general rate increase, the GRI, which goes into effect in January 2026, and they already implemented a fuel surcharge adjustment in December.
All right, finally, let's talk about the big one. The major structural change on everyone's mind, the tax-free separation of FedEx Freight.
This is a monumental shift towards simplification. The spinoff is officially on track for completion by June 1st, 2026.
And the key details.
The independent business will be listed on the NYSE under the ticker symbol FDXF.
What are the milestones that give us confidence in that timeline? Have they hit them?
They have. They've already completed a huge step. The confidential submission of the Form 10 with the SEC, that's the document that details the new company's financials, and it should become public in January 2026.
So that's when investors can really dig in.
Exactly. And for those who want to hear the whole pitch, the FedEx Freight Investor Day is planned for April 8, 2026 in New York City. This is really the culmination of their strategy to simplify the portfolio.
That brings us to the end of our deep dive. The key lesson here seems to be that FedEx aggressively shed complexity, restructured its network, and really leveraged pricing power. That high yield and digital tools like AI to drive profit.
Absolutely. They're succeeding by focusing on revenue quality over just volume quantity, even when volumes in areas like freight are challenged.
It's all about that commercial execution and strict cost management offsetting those big macro pressures.
Exactly. Growing in premium markets while optimizing their physical and digital infrastructure at the same time.
So what does this all mean for you? Well, the spin-off of FedEx Freight marks a complete structural shift. They're prioritizing asset-light efficiency and focused package delivery. So given the pressure on the LTL market right now, and the fact that FXF is already showing such disciplined yield management, how might the newly independent FDXF immediately change its strategy once it's separate from the resources and constraints of the larger parent company? That is certainly something to mull over.